among some of the names that are buzzing in trade. But like we're talking about Nykaa, good strong show that came in from the company. Margin expansion is also what we saw in Q1 FY26. Now, Mangalam caught up with Adwaita Nayar, the co-founder at Nykaa and executive director and CEO at Nykaa Fashions and head of owned brands to discuss the quarter gone by, and began by asking about the growth in the beauty and fashion segment and what's the outlook going forward there. Listen into that conversation.
We're feeling really good about this quarter for two big reasons. One is the fashion growth is back. After about 5-6 quarters of sort of a challenging environment for fashion, and I think fashion generally remains quite competitive and challenging in the market. But Nykaa Fashion has emerged really well. In Q1, the fashion business has delivered 25% growth, which is a significant improvement from the last couple of quarters, and also significantly higher than what the market is seeing, and also a very significant loss reduction with EBITDA loss coming down by 300 bips. So I think that's one big theme that we're excited about, that fashion is on track, and we're really confident that that thesis will play out. And the second is that this house of brands business that you sort of alluded to, which is where we're building our own brands, has also had a very, very strong quarter with over 70% growth. And now that one business where we make our own brands is tracking towards a 2,700 crore top line, and again, very profitable, compared to the rest of the business as well. So it's a great shift that the business is undertaking from retailer to also being a house of brands.
All right, the first quarter was good. You think that the next couple of quarters are likely to be fairly strong as well, continue the momentum. If you could give us a sense on, what kind of GMV growth can we expect in both the beauty and the fashion business over the next couple of quarters? The second half typically better for the fashion business as we move towards festive season.
Yeah, I think, beauty has been very consistent at this sort of mid-20s for the last, 6 quarters or so, and we'll hope to kind of stay steady with that. We're slightly outpacing the market growth there, and, every quarter sort of chipping away at a little bit more market share. I think fashion is where we should see an acceleration. We are feeling really confident with where the business stands today. I think Q1 at about 25% is sort of the start, I'm hoping, and we're sort of looking forward to collectively for a higher growth rate going into Q2, Q3. That is season for us, and we also have some really strong launches and partnerships that should come through to drive much of that.
Would that mean, better EBITDA margins as well? Because in your investor day, you had guided for break-even on the fashion business, at least by the end of this year. You're on track for that?
As of now, if the growth momentum continues the way it is and the way we're seeing it, even going into the next couple of quarters, there is definite intent to get to that EBITDA break-even number. If you just look at the track record, year-on-year, fashion has improved the EBITDA margin from a -9% to a -6%. And even if you just look from last quarter to this quarter, there's again 100 bips improvement. So I think the fashion team does have a track record of continuously improving the cost profile. So I think as long as both these trends sort of continue, it should be on track.
Give me a sense on Nykaa Now, because you guys had plans for that. I mean, what have the initial, numbers on Nykaa Now been? What's the investment been like? How much incremental growth have you seen in areas where there is Nykaa Now?
So we launched our Nykaa Now, which is our sort of our quick commerce proposition, a couple of quarters ago, and we've been slowly kind of steadily building on it. It's now available in 7 cities with 50 dark stores. We've serviced about 1.3 million orders till date. I think what was really important to us as a team was not just rushing into quick commerce in that form, but more finding a value proposition and a customer proposition that made sense. So when people opened up the Nykaa Now section of the app, what really was the proposition? And for us, we honed in on the widest delivery of beauty products in that that need quick commerce in the shortest amount of time. So we've spent a lot of time figuring out what the merchandising strategy should be there, and therefore I think we're really hoping that the merchandising strategy creates a lot of product market fit, and then we scale further from there.
So what's the expected scale up of Nykaa Now from here on? And could you give us a sense on the investments that it'll entail, and could there be an eat into the beauty business margin because of this?
So right now we see sort of a measured kind of foray into further expanding. We feel that this is a top city strategy, and we're going to focus on attacking the top 10 cities. We are not trying to go after the 15-minute delivery. We do state strongly to our customers that this is a 30-minute to a 3-hour delivery time frame. And we think that the customer is totally fine with that. So it is going to be more of a measured play for us.
What kind of margin guidance can you give us for the beauty business for this year, even as GMVs grow at mid-20s?
I think, it's a story of different parts. So you've got the e-commerce business, which has even higher EBITDA margins. You've got the superstore business, which is currently loss-making, though again, in our earnings, we did describe that the losses there are coming down quite rapidly. And then you've got the house of brands business in there, which is even higher EBITDA margins. So it's a mix of sort of one growth phase, investment phase business, and two businesses that are firing really well from an EBITDA perspective. So as that mix changes, you can expect the gross margin and the EBITDA margin profile to change.
All right, and final question before we let you go on House of Brands itself. You've guided for a 30% CAGR over the next few years, a target of 6,000 crore. You've already reached an ARR of 2,700 crores this year with a 70% uptick that we've seen in the first quarter. And we haven't even seen the fashion and the festive season yet for House of Brands. So what kind of growth uptick can we expect in House of Brands for this year and the year thereafter?
So thanks for talking about that. I think, for us, this is one really important strategy that we're watching play out, which is this foray into being a brands business in addition to the retailer business that we've built over the last couple of years. And I think it's astounding the growth that this business has had. It's grown 7x in the last 5 years. It is now a 2,700 crore run rate business on the back of about 10 brands, of which 3 are really sizable, whether that's Dot & Key at about 1,500 crores, Nykaa Cosmetics at 350 crores, and K-Beauty at 250. So I'm feeling really good about some of those big brands that we've got in the mix. These top brands are growing incredibly well. Dot & Key is growing at 100% year on year. K-Beauty is growing at 60% year on year. So this overall beauty side of this House of Brands business, so our beauty brands are growing at 70% year on year. So I do see a lot of that growth momentum continuing. Obviously it's not going to be at that 70% forever, but I think it's really just the start. We've just started focusing on this side of the business. So there's definitely a lot of growth potential possible here. And for me personally, what I aspire to in this House of Brands business is a very strong EBITDA margin profile. I'm inspired by a lot of the large beauty brand businesses out there, which all trend towards a 20% EBITDA margin profile. So we're trying to build these brands with that kind of discipline in mind.
Where would those margins be right now?
So again, we've not really released that yet. I would say some of the mature brands like Dot & Key are at the mid teens, and some of our newer brands, that we're still investing in are below that. But like I said, the vision over the next 5 years is to get to a 6,000 crore top line for the House of Brands business and to strive towards, best in class EBITDA profiles, which tend to be around 20%. So, I'm not sure if we'll get to exactly 20% in 5 years, but that is where and how all the brands are being built with that goal in mind.
Okay, so that's the management of Nykaa talking to Mangalam on the Q1 numbers. They do expect growth rate in the fashion business to increase going forward. That stock doing well today, up around 7% at this point in time. In fact, a lot of earning reactions which have been positive. The other one which stands out is Apollo Hospitals, which is up around 6.5%, top gain on the Nifty. Well, we'll take a short break. We'll connect with the management of Nazara Technologies on their Q1 numbers once we're back. Stay tuned.